Hey everyone, before we kick off, quick disclosure that I'm an investor in Eco, one of the companies that Joey co-founded a few years back. Now, let's jump in. All right, everyone. Today we have a guest who has done a little bit of everything. Very early into the Bitcoin space, became pretty well known in 2015 after launching what I think was the first ever token sale, public crowd sale on Ethereum for Augur, which was a decentralized predictions market, still is. Later went on to join Pantera Capital, one of the most successful venture firms in all of crypto. As their co-chief investment officer, Pantera currently manages, I think, more than $6 billion in AUM these days, maybe more, maybe a little less. And then beyond that, he runs one of the most successful AngelList syndicates of all time and is also the co-founder of Eco, which recently raised $60 million, led by El Caterdin, Andreessen, and some more. Joey, I think you are going to have to shorten your bio, my friend, if you want to come back on some more podcasts.
Yeah, I think all of that's right, except I think market's down a bit, so I think we're in the 5-something billion range, today.
Nice. That's exciting. Well, congrats, man. Let's talk about the markets, actually. This is where I want to start. We will end up talking about some really interesting L1 stuff and L2s and some more what I would call like the nitty gritty, more specific stuff in crypto. But actually, I want to zoom out as far as possible beyond crypto and just talk about macro for a second. Your partner at Pantera, Dan Moorhead, writes some really amazing pieces. And I'm assuming you two collaborate on them, on just the markets and the Fed and where we're at right now. And so I just want to get your take on macro before zooming into crypto. So where are we in the macro landscape right now? What do you find interesting? What are you looking at right now in macro?
Yeah, I mean, I think on the macro side, like the question is like, there's two questions, right? Like one is like, how much is the Fed actually going to raise rates? If you rolled the clock back, a year ago, people thought the Fed wouldn't raise rates until 2023. Now kind of the Fed's estimate of Fed members is that there's going to be 3 rate hikes this year. And then you have people like, I think Jamie Dimon or somebody at JP Morgan was saying, they think there's going to be 4 or 5, something like that. It's the question is like, how many times are they actually going to raise rates in the next year? Because if they raise them a lot, that'll probably impact risk on assets in a negative way. And then the other question is, what's going to happen to inflation? And then, so like when I started looking into this, I started kind of going down the rabbit hole of like, why do we have so much inflation right now? Which takes you to the supply chain. And then it also takes you to this aspect of like, there's this higher predilection for goods. So consumers are buying goods at a much higher rate than they used to, because they're inside, they're not going out and traveling as much. They're not, not that many people are going out and getting massages because they're worried about COVID. Like these things in the real world that you would go and do, people aren't doing as much. And so then it kind of boils down to like, you have to figure out, well, what's going to happen with COVID. And then it kind of all, recursively bubbles up from there when it comes to like a macro view. I think the way I'd sum up my view of everything I've looked into is I think Bill Gates said this recently. He thought that kind of Omicron's probably the last big COVID wave before it kind of just becomes this endemic thing that's sort of like the flu that's around all the time. And so if that's true, then you would expect to see, predilection for goods start to decrease in the second half of the year. You'd expect to see supply chains start to recover because people aren't buying so many goods. You expect to see shipping prices eventually start to level out and maybe eventually come down. And then inflation would start to moderate. So that's kind of like my current view on things.
We talk about macro a lot, but one of the criticisms that we hear is like, look, crypto has benefited from people working from home, people having more time, and then you have this rise in interest in NFTs and gaming. Do you think that goes away in an environment where people go back to work, people are no longer at home and have more time just to go outside and travel and all this stuff?
Yeah, it's a good question. I mean, I don't think it goes away. Like I think maybe the interest level drops a little bit, and then it will look like a blip on the long-term trend line when you look back 5 years from now. But I don't think it goes away. Like I think it's like it's hit like a escape velocity point where I would be shocked if it just kind of went away like Beanie Baby style. Like I don't think that's what this is. It's not hype around one thing. Like there's not just hype around crypto punks. There's tons of different categories of NFTs and different genres of things that people are interested in. So I think it's something that's not going away, even if people start to go outside more.
Joey, what you're talking about here is, I mean, if you jump on crypto Twitter, you hear talks about obviously inflation, right? Eurozone inflation at a 24-year high, US inflation at a 39 to 40-year high. Crypto's almost like the community feels more like powerful / engaged than ever before, at least than I can remember it. But what you're talking about is actually kind of counter to that narrative, which is what you're mentioning is inflation might decrease. Maybe we're at like a this year's high for inflation right now, and maybe people will actually start going outside again, and maybe some of these communities will almost like disform from what we've been seeing in COVID. And so these are kind of like counter to the bullish crypto narrative. So how do you find crypto playing into this macro narrative? And is that fair to say, like what I mentioned before, that some of the stuff that you're seeing might be, and your macro theses might be counter to the bullish crypto narrative?
Yeah, I mean, I think I wouldn't say it's well, okay, it's counter to the narrative. It's not counter to the bullishness of it. It's the way I would describe it is, I think a lot of people in crypto, they say, oh, inflation's really high. That means crypto is going to go up because it's a inflation hedge. Well, there's a couple of things there. I mean, one of them is markets are forward leading, right? So like if inflation is really high, it probably means at some point it's going to drop in the future, which means like the macro kind of forward leading thing to do is like maybe de-risk a bit of crypto as inflation starts to moderate. The other angle you could have there as well, the Fed's going to raise rates and you don't want to fight the Fed. So, crypto is probably going to drop a bit as the Fed raises rates until the market really prices in how many rate hikes there are. Obviously, like it's not like we need to wait till the 5th rate hike and then, it's up from there. It's totally plausible that like, say the reality is the Fed does 4 rate hikes and then things kind of level out. Once the market starts pricing in 4 rate hikes, the market's probably bottomed and then you could buy it then, even if we're only on rate hike number 2, is kind of the idea here. And so I think when I think about inflation, I think it's actually beneficial for the crypto market if inflation tapers off because of the fact that today crypto is still so nascent and so young. It's a risk asset. Like, I own over like 95% of my net worth is in crypto. And I view that as like, it's a risky move in the short term. It's not a risky move in the long term. But if you think about it from the short term perspective, as rates go up, people start to de-risk their portfolios because they think other people are going to do it. And then eventually the market prices in however many rate hikes there's actually going to be. Right now, the market's pricing in roughly 3. I just looked at the CME's website this morning. I think they're pricing in roughly 1.1% short-term rates by kind of like early next year, federal funds rates. And so, if that's right, then maybe we've already bottomed. If the actual rate ends up being 1.5%, then, the bottom hasn't happened yet. But I think it's mostly the way I sum it up because I'm very bullish on the space. I just think that if inflation keeps going up further, it's actually a bearish thing because it means the Fed is going to have to hike rates higher. And if you look at crypto, you have Bitcoin, let's toss that aside for the moment. Everything else like the ETH space and the smart contract stuff, they're effectively tech companies. People are going to hate that framing, but just like roll with it for a moment. They're tech companies in the sense that, if you look at like the discounted cash flows of them, as rates increase, the risk-free rate is higher, and so your valuation is inherently lower. And so it's actually good if inflation tapers off is how I describe my thesis.
Yeah, and Joey, I think just putting, I think it's really hard to predict short-term movements in macro, generally, at least in my perspective. I am curious, just zooming out, you've been in the space for a while, you're a builder, you're an investor. You've seen multiple cycles. I'm curious, like, what are the things that have surprised you the most throughout, I think what you've seen now at this point, 3-4 cycles. You could argue more depending on how you count these, but I'm curious, what are the things that have surprised you the most over the years?
Yeah, I mean, well, the most surprising thing, when I first bought Bitcoin in 2011, the price went down, to like 2 cents because Mt. Gox got hacked the first time. So that was the first very surprising thing over the years. But I think like, if you look at like this most recent cycle, I mean, one of the surprising things is that you kind of had this, effectively like, double top, but then the second top wasn't, like a crazy high top. It was kind of, like this, we hit 69K and then it's kind of tapered off and you've kind of had these really long consolidation periods within the bull cycle period. And like, if you look at prior crypto cycles, you kind of have like the consolidation periods typically happen in a very bearish phase. And I guess what I would say is I don't really think we're in a bear market right now. I think we're just in a consolidation kind of chop in the bull market. Like I don't think we've seen kind of like the crazy peak yet of this cycle is kind of how I would describe it. And I think that the length of this cycle, I guess, is somewhat surprising. and I could see like it's sure it's plausible that Bitcoin touches 30K. It's also plausible it goes back to 50, 60K. I don't foresee like another 80% drawdown, at least from where we were, right? Like I don't see 80% drawdown from 69K. If we had hit 150K, yeah, that seems plausible.
And why is that? Because a lot of people like obviously look at the prior cycle and say, hey, look, alts went down 90%, Bitcoin ETH went down 80% or so, 75, 80%. Why is that the case in this case? Like, why is it not possible?
There's a couple of things. One, the space is much more mainstream than it was back then. Like back then, it was kind of almost only people within crypto who were trading the asset. Now you have people outside of crypto. You also have capital allocators who aren't going to sell at all. Like they're like 10-year lockup style money. And then you have, and a lot of those funds, like it's just not in their mandate to sell. Like even like the advent of like crypto funds, I think like if you look at some of these hedge funds, some of them almost never take risk off. And like in the early days of crypto, like go back to 2011, 2013, it was almost all retail, and those people were trading it around a lot. And then I think that's part of it. I also think liquidation engines have gotten better over the years. Yeah, you'll still have liquidation cascades, but like, hopefully March 2020 is a thing of the past. It's not impossible. I think the odds that happens today are lower in the market than they were back then, just because I think our liquidation models have improved. But yeah, it's certainly not impossible. But I think the last piece is you just still have this kind of huge influx of capital, and we're seeing it from Pantera, this huge influx of capital on the institution side that like in 2018, 2019, you didn't see that. Like our inflows were very low back then. There wasn't kind of this continuous trickle of capital coming into the market in those days. And so it made prolonged slides, get much deeper than they probably otherwise would have.
Joey, I want to double click on this market cycle narrative, because I think that the kind of market cycle narrative 6 months ago was, okay, Bitcoin just ripped higher from, I think it was like 30K in July up to 65K. And a lot of the folks who had been around for 4, 5, 6 years said, okay, guys, you're all excited right now. You don't understand what a bull market really looks like. You don't understand the FOMO that will be in the air. You don't understand. It's when CNBC is telling you how to buy Ripple. You guys don't, you just wait and see, right? This thing's going to 250K. 6 months later, we're sitting here. The commentary is the exact same, but flipped, right? I feel like there's a lot of commentary saying, guys, no. The market's fallen to 35, 40, 42K, I think today, but you don't understand what a bear market feels like. This thing could go way lower. You don't understand how bad a bear market could get. But it sounds like your narrative and just the way that you're framing the market cycle right now is we're just going to get chopped for a long time. We might see 3, 6, 9 months of just chop and consolidation. Is that right? Yeah,
I think the way I describe it is like, it's one of those things. So markets always tend to do, I mean, like, Santiago, you mentioned like, what have I learned over those cycles over the years? I mean, one of the things I learned is that markets kind of do what you rationally don't expect them to do. And so like, I remember last year at one point thinking like, well, like the narrative you were talking about, Jason, like I remember thinking that kind of popped into my mind, and I started to believe it for a while, and then I kind of caught myself. And I think, right now you've kind of flipped to the opposite extreme on Twitter, right? People are like, oh, it's going to be another 8% drawdown bear market. I think the markets tend to kind of prove most observers wrong. And so I think in this case, I think it's probably going to be chopped for a while, especially as we raise rates. Like the market could go a bit lower. There could be like a liquidation cascade that happens, where it drops a lot and then bounces back pretty quickly. But my kind of read on the market is mostly just chopped for a while until the market has a clear read on where inflation's going and where rates are going. And it's something where, there's kind of this attitude in crypto, like, oh, we don't have to pay attention to macro. Like, I remember somebody said on Twitter the other day, like, everybody in crypto trying to pay attention to macro, it's like dumb. You don't know anything about it. And like, I used to not pay attention to macro either, because it's like the space is so small, you don't need to pay attention to it. But then like, earlier this year, I kind of had like a wake up call. It's like, I actually need to educate myself on macro, because if I don't understand it, like I'm not actually as effective as an investor as I should be in this space. And so I think it's a mistake not to pay attention to macro in the space.
One thing that I want to, perhaps if you can lend some perspective on is, we talk about correlation within crypto quite a bit. And it felt like last year there was an attempt for ETH and some other pockets of crypto to break this tight correlation that you see with Bitcoin, especially in moments of volatility. A lot of people the argument that, you know, a lot of folks over the years have said, look, Bitcoin's an uncorrelated asset class. And this is something that we keep hearing over and over. But when you actually look at the data, it's actually quite correlated. It has a super high beta. And in the moments where you need it to be most uncorrelated, it actually breaks. And, you know, people forget, but Bitcoin hasn't, and the space in general hasn't gone through like a global financial crisis. And so I don't candidly buy this argument that it is a uncorrelated asset class. I think it's super correlated. It will continue to have a really high beta. It's a risk on asset. The same with the tech kind of behaves relative. Like the Nasdaq is down 10%, the S&P is down less than that, and so I think it's sort of disingenuous to assume that this is going to be uncorrelated. But one of the things that I think has changed over the years is the type of investors coming into the space. Perhaps you had more macro funds kind of playing this Bitcoin small allocation trade. Whereas now you see, just as you said, more permanent capital base, more like tech focused investors, which have a much longer time horizon. I am curious. I mean, Pantera has 4 funds, right? I think 4 or 5 funds, different strategies. How has the composition of your LP base changed over the years, and what kind of interest are you seeing from your funds? And is that true? What I just said is that true? The level of interest that you're seeing from investors in the space?
Yeah, I mean, I think that's true. If you look at our LP base over time, in the early days, it was basically just, Dan, who, when he started the firm, it was, his money and I think like 2 or 3, friends from college. And then, over time, we added more high net worth individuals. Then the next kind of tier was like family offices. Then after that, you have multifamily offices. And then, I think in 2018 or so, we kind of got the first couple of like smaller institutions, whether that's other venture funds, wanting like to share deals, who are maybe at the later stage than us, or you also have, I would say, like some corporates who are looking to kind of educate themselves on the space. And then I think if you fast forward to today, the next kind of category of investor is like some of the endowments and things like that. And then kind of I think probably the last tier would be like pensions, they just move slower even than endowments. And at this point, we do have some endowments in the fund. And so I would say, what they're interested in. The other thing about permanent capital, they're more interested in our blockchain fund, which is our, it's a multi-strat fund. It's just all our other strategies. So early stage venture, early stage tokens, and liquid token trading in like a venture style, 7 to 10 year fund. And they like that because, one, they don't have to decide what to allocate across. Like no capital allocator who's a large institution wants to decide what percentage they should put into 3 different funds. They just want to buy one vehicle, in our experience. And then I think the second reason they like it is because they don't need to have a meeting once a month where they're talking about the performance. They can revisit it on a quarterly basis and maybe seriously look at it on an annual basis. And it's a much like calmer thing than like having like a monthly performance report in a really liquid hedge fund. So I think that's the other reason why capital allocators are moving towards that style of fund.
Which of these funds has performed the best, and why would you attribute the success? I mean, because like the blockchain fund sounds like it's very long-term focused. Liquid token fund is sort of very actively traded and perhaps looking at social signals and other stuff to be more opportunistic. The venture fund is probably investing in early stage stuff. I believe you have like just Bitcoin only product. And so I'm curious, like, one, what strategy has been perhaps the most successful? And I think it's a trick. It's a difficult question, right? Because you have to factor in Sharpe ratio and Sortino ratio, which is a sort of nebulous concept. But nonetheless, like, which have been historically the most successful? Which strategy you think is going to be the most successful going forward, and why?
Yeah, that's a great question. I think historically, if you kind of look over the years, I think our early stage token fund has been the most successful in my opinion. Mostly because it's kind of a strategy where you have an insane amount of edge, right? And like the edge that you do have is high. And I guess the way I describe it is you're investing in these token projects very early. It's a relationship based style of business. You're actually trying to add value to them in certain ways that kind of yields referrals in a sense, like other founders refer you other founders, and if they have positive things to say about you, then it's kind of a virtuous cycle. Which is why I think, like, if you look at venture funds, in Silicon Valley, they're kind of, ignoring like maybe a couple rare exceptions, they're basically like the highest returning asset class you can invest in. Obviously there's risk involved, but they're very high upside. And I think in crypto, those tend to be tokens. Like there's more upside in tokens than equity, at least based on our performance historically. If you look at the liquid side, I mean, last year, so you look more recently, last year, our liquid fund actually outperformed our early stage one. So our liquid fund was up about 385% and our early stage was up 294%. And our liquid one outperformed, I think, because a couple of reasons. One, we did take risk off a few times throughout the year. And so that kind of compounds where if you take, 25 to 35% risk off and then the market goes down 30% and then you put it back down at the lower level, that starts to add up a bit. And in the early stage fund, it's much harder to do because the positions are much less liquid. It's more like navigating, a cruise ship that's like a venture fund that has liquid pricing. And so I think that's kind of probably why liquid outperformed, our early stage one last year. But over the history, early stages has beaten it.
Joey, is there something that that your the actively managed fund, the liquid token fund, has noticed as like a very clear signal to go risk off? Whether it's social signals, quantitative signals, is there something that makes your team say, "Oh my God, now it's obvious. Let's go risk off for the next 30 days"?
There's not one thing. I wish there was. I think like the types of data we look at are things like we look at like sentiment. I think that's useful. We also look at like different types of on-chain data. Like a lot of the kind of stuff you can see on like sites like Glassnode and stuff. I think is informative. There's also like, liquidation data you can get if you like, reconstruct when people put trades on and stuff. You can kind of get some interesting data about where the likely liquidation levels are in the market. I think in crypto, it tends to be, this is something that I used to not believe in. And then I kind of realized I was wrong. Like, crypto is pretty technical analysis heavy. Like people pay attention to that stuff, even if like there's no rational basis for why it should make sense. If half the traders in the market are paying attention to something that they view as significant, it kind of inherently is significant, even if it otherwise would have no significance. I think those are the kind of the main things. And that stuff, you'll catch about like half of the risk off moves with those sorts of things, but the other half are much harder. They tend to be idiosyncratic things. Like we caught the January and February risk off moves. We didn't catch the May one. Like the May one was driven by, mostly driven by like a lot of news that came out, and also a lot of news that came out, during time periods that I would classify as like manipulation, like in the sense that there's a lot of this news that came out of like these like Twitter accounts that are called like, I forget the names of them, but they like tweet like Bloomberg headlines, and some of them were tweeting headlines that were just like made up, and they were tweeting them right around both key technical levels and right around key stop loss levels in the market. And like you'd see the tweet, and then like within seconds to minutes, the market would tank a lot. This happened a few times in May. It just kept pushing the market lower and lower, and it's really hard to trade off stuff like that because you're not the most informed actor. Whoever's putting that tweet out there is more informed than you.
How much of what you do on the active fund is kind of algorithmic? Is sort of like more like, I don't know, hands-on versus just some sort of algorithm trading around certain signals that you're pulsing, wherever that may be?
Yeah, I'd say our ordered execution is mostly like a lot of algorithmic stuff, but I'd say our actual trading is mostly fundamental and kind of discretionary decision making. We have like dabbled with quant over the years, but it's hard to find like a sustainable edge that you can deploy at scale. If you look at successful crypto quant funds, they tend to have, sub 100 mil under management, like firms like Temple Capital and Ophiris and things like that. If they're doing like portfolio driven strategies. Obviously, if you're doing market making or prop trading, the rules are different. Like if you're like an Alameda, we're not running those sorts of strats.
I want to go back to something that you said, which I always found to be super difficult in the space, which is this is sort of a liquid venture category. You're investing in super early stage stuff. You could argue that everything in the space is quite early, even Bitcoin. Certainly anything other than Bitcoin, in my estimation, is very early, behaves like very early stage. But you take a risk off, right? As a fund, you have a certain fund life cycle, you have redemption windows, and or you just believe that certain things trade. I'll give you an example. Like maybe your investment horizon, something like Augur, for instance, is in 10 years out. prediction markets could be probably one of the most asymmetric categories in the space. They could totally reinvent how we think about information and changing the way media behaves and creating, it's fascinating, but sometimes things that you think are going to happen in 10 years happen in 3 months. And the price prediction that in your model that you're thinking, okay, maybe this is a 10-year bet, but how do you manage risk? And you mentioned that you guys have taken off risk. Is that because you just inherently, the things that you thought were going to happen in 10 years happen in 3 months, and then you just need to systematically size down because as a percentage of your portfolio is too high, or just because you think it's better to, enter the market when things cool down? I'm curious how you think about managing risk. Or are you just saying, look, I'm just going to hold this for 10 years and it's going to do this, but if you smooth it out over a 10-year period, it's better for me. It's more tax efficient for me not to even trade this and just set it and forget it.
Yeah, so I think our attitude towards risk depends on which sleeve of the strategy it is. So like for things like the liquid fund, I mean, yeah, I agree with your point that even the stuff in the public markets is effectively venture anyways. I think on that one, it's easier to kind of take risk off, both because it's more liquid. The assets we're trading there, they trade more volume, they're easier to sell, but also because the expectation of the LPs isn't that we're going to hold something for 10 years. I mean, we in theory we might, right? But I think in practice we would probably trade it around. And I think when it comes to trading stuff around, you kind of look at things like we discussed earlier in this call, the technical stuff, sentiment stuff, on-chain data, things like that. When it comes to things like the early stage token fund, where you're investing in really early stage projects that you'd like to hold for a very long period of time, I think there, when you sell a position or take some risk off, there's two reasons. One reason we do very rarely, and one which I think we do sometimes. And the one we do very rarely is taking risk off across the board of the portfolio because we think stuff is expensive. We did that I think once last year, and then we put risk back on within a number of days after the market fell. We don't do that too often, only if we have really, really high conviction. I think the other category is when we think something has, the thesis has changed, and the thesis can change for a few reasons. One is it's clear that it doesn't work. Maybe, you thought the team was really great executors and it turns out they can't execute, and, half the team left. That's hopefully if you de-risked it before half the team left, hopefully you figured it out sooner than that. But that would be an example where you'd want to, sell a position. The other would be, as you mentioned, if it's way, way out of whack. And the question is what's out of whack? And generally the problem with in crypto is it's usually much higher than your rational brain thinks it is. I remember when Polkadot went live, I forget the exact percent we sold. It wasn't very high. It was somewhere on the order of 10 to 20% of our position that we sold when it was shortly after it went live, a couple months after it went live. And then I remember, we kind of debated internally, should we hold the rest of the position or not? We concluded to hold the rest of the position, and it's up maybe on the order of, I don't remember the exact multiple, but it's 4 to 6x higher than that even today after the drawdown, when we decided to hold it. And it was a very large position at the time, and it's a much larger position now. And so those sorts of decisions in crypto, I think, are very hard. I think I tend to be biased in favor of holding stuff just because, I learned this lesson early on in crypto, but you tend to lose more money selling early than you tend to lose holding through rough periods. There were a bunch of funds that went bust because they sold, when the market was down 70% in the bear market. And then, they didn't buy back when it was down 87 or whatever, And so my short view on this is, you're generally better to be biased in favor of holding things than selling them just because of the way crypto is so convex in terms of its outcomes.
On that point, do you, of course it helps that if you're open-ended fund, you can continue to raise capital and, deploy in the bear, if you will. But it's sort of hard at that point maybe to raise capital. I am curious how you think about, this current market environment and, are you rotating your portfolio back into ETH, back into Bitcoin? And especially for those early kind of, is there ever a time where one fund, for instance, say the venture fund, invest in an early stage project, you've already vested, you want to take some chips off the table because you see more upside in investing in more early stage stuff at a lower valuation, maybe a different category that, gaming or whatever that is now more developed, and you see more upside. Does that ever present like a challenge or a conflict with perhaps a liquid fund that might have a position in that particular project that is liquid? And how do you manage kind of that tension within kind of your funds to to make sure that you avoid some sort of conflict?
Yeah, that's a great question. So there's kind of a couple of answers there. One is on, take the venture fund three as an example, or early stage token fund or whatever. In those funds, they're kind of firewalled to their own strategies. Like venture can't turn around and go buy it can't sell a really expensive venture deal and buy tokens. Now, the blockchain fund is more interesting to answer this question because it can do things like that. In fact, it's kind of one of the big selling points is it has the flexibility to be able to, say venture's overvalued, we want to buy tokens, or tokens are overvalued, we want to buy venture. We can do things like that. The only area where you really start to run into conflicts and mitigating them is in things like, what if the blockchain fund, is investing in an early stage token deal? Well, the early stage token fund is going to invest in that deal too. And then so like the question is, how do you allocate the deals across the two funds? And there's a pretty straightforward answer to that. Like you allocate them effectively based on their relative liquid AUMs minus, redemptions that you have on the books. And so it's sort of like, what's the actual capital available for deploying into these strategies? And then you just split it up pro rata. And so that's how we split our deals up. That way we're not ever being like, oh, should we put this in the early stage token fund or we should put it in the blockchain fund? Because then you start to get into really weird conflicts of interest. We just split them up pro rata based on sort of like AUM, although it's a little more complex than that.
Joey, talking a lot about the venture side of the business right now, I think you have a really, really unique view into the next 24 to 36 months just because of where you sit investing in a lot of the early stage deals. And so when I look at kind of the big trends of crypto over the last couple of years, right? It's like 2017, the ICOs, 2018, like maybe exchanges, you could say, 2019, like institutional infrastructure, custody, prime brokerage, some of those kind of things got big. 2020, I would say DeFi was the narrative. 2021, last year was NFTs and then into the metaverse. So take us a couple of years into the future, or maybe even just this year. Like what are those kind of 1 to 2 line trends for 2022, 2023, 2024 that you're really, really excited about?
Yeah, I mean, I think the stuff that we're seeing is like, one is like more complicated DeFi stuff. DeFi 1.0 is kind of like primitives, right? It was like, yeah, you have lending markets, you have markets to trade, you have exchanges. And then I think the kind of next wave of DeFi that we're funding right now, and others are funding as well, is, more complex stuff, whether that's, automated DeFi insurance where the payouts are, based on smart contracts as opposed to humans, or, things that let you create, different risk tranches where two people can contribute to a liquidity pool and one can post ETH and one can post to stable coins. And, we as a fund don't need to borrow stables to do it. Things like that. You also have a lot of more kind of like contract to contract interactions where, there's different projects that are working on like making it so that they can provide liquidity to another project. You have a lot more happening in the decentralized derivatives space. There's a lot of like decentralized options protocols being created right now. And then I think, then you also have kind of all this scalability stuff that's finally starting to happen. More and more projects are building on things like, Arbitrum, Optimism, Starkware, other chains like Solana, Polkadot, Near, that kind of stuff. And I think the second area that I see is, on the NFT and gaming and kind of metaverse stuff. I think on that area, I think right now what you see is you see a lot of very simple games that aren't that fun to play. Like I played Axie Infinity the other day, and it's obviously a very successful project, but it's just not that fun. It's not a very fun game to play. Like you're just kind of clicking a few buttons here and there. And I think what will change over the next 2 to 4 years is people will actually create games that are fun to play. And I think if you look at all this metaverse stuff that's happening, a lot of it's doesn't really feel that much like the metaverse. So like as an example, a massive MMO like World of Warcraft feels much more like the metaverse to me than, something like Fortnite does. And I know that might be a controversial statement, but I think something like WoW it's much more immersive. It's kind of like you're much deeper into it than you are into like a Fortnite game. Obviously, it's missing a lot of things. It's missing the interoperability. It's missing like the open, network. WoW is a very walled garden. But I think what will happen in crypto gaming is I think people will take the interesting parts of traditional gaming, like great graphics, great design, like games that are actually fun to play, and then add crypto to them, and have these kind of like more open networks where you can transfer items across games and stuff, and that actually starts to get a lot more interesting. But like transferring like you know one axie to another game that's compatible with it, is like not as interesting, I think, just because it's like the games aren't fun to play. Not trying to be mean. It's just like I think these games can be a lot more fun than they are today.
So there's a whole bunch of things we can talk about there. There's one area specifically I want to dig in on. It's something that Santiago and I have been talking a lot about on our on the weekly roundup episodes, which is tokenomics. And you mentioned like more complicated DeFi, and this is what comes to mind. So really what it feels like to me, and you can tell me if I'm wrong here, is it feels like the last couple of years we've kind of just been in the mode of like launch a token, right? Get the token out the door and figure it out later. And now we are in the figure it out later phase. Things have become like a little less speculative. A little bit of the froth has gotten sucked out of the markets. And now founders and protocols are changing their mindsets and saying, how can I tweak governance to actually accrue value and improve the value of the platform? And how do I incentivize users to do all of that, right? So you had like Olympus DAO and like Ohm and Ohmies, and then you have the curve wars, and then now you have like Yearn changed the tokenomics. Now you've got Daniel Sesta and Andre working on a big new project, and a lot of it is around like this VE model, like the voting escrow model. And so I'm curious, like when you think behind the scenes, like take us a little bit, peel back the curtain behind the scenes. You're talking to a lot of the founders who are creating these token models. What's the conversation around tokenomics these days? Like, what are you seeing?
Yeah, I mean, I think one way I describe it is like, I mean, you're right. People are kind of trying to ship tokens. I think like if you look at what people are doing, I think in the old days, I mean, and I'm someone who I would certainly say myself, I got this wrong. Is like with Augur, for instance, we focus so much on getting the economics really right, from like a design standpoint, like making sure it's game theoretically secure and completely decentralized and all this stuff, and not enough on like how do you actually get like product market fit and like lots of usage and stuff. I think both are important, but I think like in the old days, people focused too much on the token design and economics piece, and then maybe today they're focusing a bit too much on the product market fit piece and forgetting about the economics. But I think my view is that it's easier to get um, it's easier to build a good token model than it is to get product market fit. Is at least a lesson I've learned, and maybe it's one that I've just like past scars have biased me in favor of that, but that's kind of my read. And so I think like people are putting a lot more focus on that, getting product market fit, and then once they have it, then they're going back and saying, okay, how do we make sure that like everything's incentive aligned and the token model actually makes sense? Um, and and I think that's kind of just starting. Like we're just kind of starting to see projects really start to take that part seriously now that they got product market fit. Um, is how I would describe it. Another thing we're seeing on the token side is, back in 2020, for instance, projects would do these like liquidity rewards where they kind of give away a lot of their token. Now projects are much more careful and thoughtful about that, like how they give it away, like how they incentivize people there. Like one project we invested in is called Sin Futures, a decentralized derivatives exchange. And they tried to get product market fit and have their trading activities growing pretty well before launching the token at all, which I think is like a smart model, because
Yeah.
if you start with the token from day one, you don't really know whether you have true product market fit or not, because you're giving people away free money.
You talk about DeFi 2.0 a lot. I don't think it's perfect either. I mean, obviously it's an improvement on DeFi 1.0. The space continues to improve. Face today, if you could invest in a DeFi 1.0 project or a DeFi 2.0 project, maybe DeFi 1.0 Maker or Yearn, you could argue Yearn is maybe like transitioning more towards 2.0 and adopting some of those like mechanisms, but still, Old Guard, Compound, Uniswap, Maker, Aave, and now you look at 2.0, which, a lot of times when I remember talking to a lot of these projects, like they inherently are faced with the challenge of trying to pass, maybe restructure the token. It's very difficult to do, sometimes impossible. And so do you think that like DeFi 1.0 projects are a material disadvantage to these new wave of projects that are, learning and taking a lot of the learnings of 1.0 and improving upon that mechanism? And if you give specific examples, it'd be great.
Yeah, that's a good question. I don't think they're at like a huge disadvantage in the sense that like, okay, you take DeFi 2.0 as an example, there's going to be a DeFi 3.0 at some point. And so people need to figure out how to like, iterate on what they have in a decentralized fashion and do so in a way that isn't extremely cumbersome. And if people don't figure that out, that's kind of a big problem for the space in general. And so I think they're at somewhat of a disadvantage, but not a huge one. I think from an investor standpoint, if you look at the DeFi 2.0 stuff, there is some stuff that I think is like interesting, like like Icicle Finance seems pretty interesting. There's also a lot of stuff being built on Arbitrum that I forget the names of them, but there's a bunch of like derivatives projects built on top. And if you look at them, like relative to their attraction, they trade at pretty cheap prices. Some of it's stuff that's like too low market cap for us to be able to buy like in any reasonable size. But if I was a retail investor or a smaller fund, I might look at stuff like that. And they're kind of like, and they're maybe like DeFi 1.5. They're not like the ice spell, like frog ecosystem kind of stuff. They're simpler than that. But there's still a lot interesting happening there. I think DeFi 2.0, the problem I see as an investor in it though, is a lot of it's just really crazy expensive valuations. Like from any, and again, crypto is one of those things where something that can look expensive, then it's 50x up from that, and then it's like, okay, maybe it wasn't actually expensive. But I think right now, given that the market's kind of entering this kind of cautious chop period, I think it's probable that we'll be able to buy some of that stuff at much cheaper prices. And also after they've figured out a lot of like the R&D stuff that kind of hasn't really been figured out yet. And so like we haven't put too many large positions on 2.0 projects. I mean, we have on the early stage side, just not in the public markets.
Right. Could you argue that, DeFi probably is closer to a bottom, especially DeFi 1.0 is closer to a bottom with much more fundamental traction and support than perhaps some of the metaverse, some of the, NFT infrastructure, DeFi 2.0 projects, maybe other L1s that, obviously have a lot of incentives and, ecosystem funds, but perhaps not as many users, and or kind of sustainable token models. Certainly short term might be interesting, but maybe not as kind of organic traction, if you will. I'm sort of curious if you believe that to be true. If not, kind of how you think about maybe zooming out a little bit of just kind of playing this multi-chain strategy. How much of your portfolio is in Ethereum and Ethereum-based projects, or do you see much more upside in other ecosystems like Near or Terra or Solana or Cosmos, if you will?
Yeah. I think I do agree with that on the DeFi 1.0 side. Like I think that stuff is just cheaper. And I mean that's a phrase in traditional investing. Stock that's cheap, can get much cheaper. But I do think that it is closer to bottoming than other assets in the space. Also because like there's just a lot of fundamental traction there, and I think when the rest of the space recovers, those fundamentals will recover in kind of a really nice positive recursive way where something's trading at a implied earnings multiple of 15, and then the price of Ether doubles, it's probably trading at a PE multiple of 7, either that or the price doubles, or more. And so I think it kind of provides this bit of a margin of safety. An example of this in the last cycle, it's not quite the same and it was a much higher multiple as if you look at Binance Coin. It went down less than other stuff in the bear market because Binance had volumes, and volumes did go down. But if prices across the board went down 80-something%, volumes actually didn't go down 80%. They went down a lot, but not 80. And so the price of their token wasn't as impacted as, say, a random bag of altcoins. And I think in DeFi is kind of a more extreme example of that. It trades at much cheaper multiples and stuff like BNB did back then. And so I think that could totally be true, and it's a thesis I hold. I think you look at different chains. These other layer ones, like we're investors in some of them on the early stage side, and we'll hold them a very long time. I think on the public markets portfolio side, they're more expensive. Like I'd rather be buying, new projects kind of built on top of, things like Polkadot than buying another 100 million of Polkadot. I just think there's a better risk reward there.
Is that true generally of the ecosystems, where like if you think about like your exposure to the base layer kind of dots, atoms, versus playing the application layer, do you typically kind of position your portfolio that way, where you say you like Cosmos, for instance, you're more likely to invest in applications being built on that particular ecosystem versus the base layer token. The reason I asked this is we had the multi-coin guys earlier, and they mentioned, look, the best way to play a lot of these is not owning DeFi tokens. It's actually just owning the base kind of the token, given an MEV, particularly for Ethereum, for instance. It might not be true for other kind of tokens or ecosystems, but I'm curious to get your perspective on this kind of the ratio between application layer versus kind of base consensus engine layer.
Yeah, I think right now we're pretty heavy base layers just because I think, while the market's a bit choppy and I'm not 100% sure that DeFi's bottomed yet, I haven't kind of pulled the trigger to flip back into that stuff more heavily. But I think over the years, we've tended to be pretty heavy in, non-base layer stuff. Sometimes that works, sometimes it doesn't. And, I think for base layers, if you look at Solana as an example, it's came off a lot since the peak. And the early stage projects on top actually aren't that cheap. If you look at Serum, its valuation is not even that far from the underlying layer ones. And so on a relative basis, I'd rather own Solana than Serum as an example. And so there are exceptions to the rule, but I think if you look at Polkadot as an example, I forget what price we paid for the Series A of Akala, but on a relative basis, it's a much higher EV trade. I'm very bullish dot too, but between two high EV bets that I love, I think Akala was a clearly higher EV bet. But yeah, there are exceptions to that rule.
Yeah, not to mention Betty and Retail are just savage operators in the good sense of the word.
Yeah.
I am curious, you talk about Serum, for instance, relative to Solana. I assume you're talking about the fully diluted valuation, because how do you think about, and are there, going back to kind of first principles, mental models, do you focus a lot on fully diluted, circulating? Do you look at +2, +3, +5 years and just look at the token emission schedule and where that's going? How do you talk about fundamental valuation, relative valuation? How do you think about specifically around kind of looking at comparing projects on a relative basis, and if that's on a circulating or fully diluted basis?
Yeah, great question. I look at fully diluted because, I would say you think about investing in early stage startups, I care about fully diluted. I don't care about, circulate. I don't care about what investors own in their preferred stock and that's all that's circulating. There are certain cases where preferred stock, you do need to pay attention to it, in acquisitions and stuff, but generally you care about the overall valuation. What are you investing? What percentage of this thing do I own? What percent of the cash flows do I own? And I think if you're doing really short-term trading, you can kind of pay attention to circulating and you can try to trade around the retail market sentiment and stuff, but it's pretty complicated and it's kind of it's a game that's it's not that interesting to me, and I think it's very, very complex to play. And so I prefer to just look at fully diluted because I know what am I buying here.
Do you have a baked out thesis on how these quote unquote L1 wars kind of play out over the next couple of years? Multi-chain future, ETH only, another chain, 8 different chains, each chain gets their own thing, 2 or 3 chains win it all. Do you have a baked out thesis here yet?
Not super baked out. The 2 different things I thought of are one idea is maybe it's kind of how if you look at the database market, you have a handful of databases that are really popular, and then you have a really long tail of a million other options that are kind of obscure. Another could be the Linux distribution market. Another one that's even wackier could be, you think about it in terms of world economic powers. You tend to kind of have 1 or 2 that are kind of the global, the global hegemons, so to speak. And then you have kind of a longer tail of stuff that's still relevant and still powerful, but it's not the top one. Today you might say US and China, and then an example that's still a very relevant player, but not the top one would be Japan or Germany. That could be how it plays out. I do have conviction that I don't think we end up with everything's, only on one chain. I do think we'll end up with, when people have a very serious thing that they want to do settlement for, a massive transaction. I do have pretty high conviction that will probably take place on Ethereum, just because of the set of trade-offs that ETH is making on decentralization. I think are kind of the most conservative ones, and also in terms of security. But I think where are metaverse games deployed and run on, is I don't know. I have no idea. That's kind of my view.
Does it feel a little bubbly and hypey. Like, it feels like last year you had Solana and Avalanche, obviously had really good years. Now to kick off this year, you're starting to see like Phantom and Near are having a pretty good time. Obviously Luna had a good year last year as well. Like, I guess just more shorter term, like what did the next 12 to 18 months look like for the L1 space, would you say? Is it like people start chasing the new L1s, like trying to chase the new Solana and Avalanche and Luna, or like where does this play out?
I mean, I think like it starts to hit saturation at some point. Like I think like the layer ones people are kind of coalescing around, with maybe the exception of Phantom. You know, there are kind of things that have been around a while, but just more and more people have coalesced around them. Like Luna's been around a while. Like, you know, Solana's been around a while. They're starting to get easier to use and easier to build on, which I think is why more and more people are coalescing around them. I don't really foresee like another massive layer one wave in terms of like new layer ones. I'm sure there will be some over the years, but I don't think we'll have another boom like this one, just because of there's only like so much more you can move the needle there, like in the sense of and maybe it'll look like, you know, Bill Gates, or I think it's an apocryphal quote, but somebody said, you know, we'll only need a certain amount of RAM forever. You know, and you know, maybe that's what this statement will look like. But I think if you look at layer ones, past like 10K TPS, you start to get really diminishing returns, especially for financial use cases. Obviously, gaming and metaverse social stuff is different.
Have you, in sensitive to the fact that you may not be able to kind of provide full insight, but if you could describe kind of the worst trade that you've done over the years, and have you adjusted, corrected course, and rebought a particular token? Say that you held a big position, and at least I've noticed I'm a terrible trader. I'd say Jason's probably also know this, but you know, sometimes you just kind of punch out of a position because it's frustrating. Things are slow. You can't justify. Kind of you look at kind of weak users and traction, and then all of a sudden, kind of you punch out, and then you know the market does what it does. It's kind of irrational and you know mimetic, and you know kind of forces at play. Do you ever kind of reevaluate something and buy back, perhaps at a higher price? Is that something that you guys constantly kind of re-underwrite your position and are willing to kind of take that loss, if you will, and you know buy back into a position?
Yeah, I have two different answers. Well, so first of all, worst trade I've ever done, I mean, probably would be selling Matic in December of 2020. You know, it was 1 or 2 cents, and now it's $2. That one I sold it because, I mean, we were working with them, like the Augur team was working with them, and they kind of like, you know, like a lot of the team left, who we were working with, which I always view as, you know, not a good sign. And then like a lot of the actual like kind of like security features that Matic was supposed to have, we found out actually were like years away and not actually implemented. It didn't really work. And so, you know, my thesis was, well, Pantera has a very big Arbitrum position already, like, you know, and Starkware, like, you know, we own a bunch of the leading layer twos anyways, like maybe I'm just wrong on Matic. And I'd held it, you know, for a long time prior to that, and we ended up just, you know, selling it, and obviously terrible trade. I don't think we bought that one back. I don't think we did. There are definitely other things though where we've passed on it or didn't do it and then later bought it. And Luna is an example of this. When they raised their private financing, we thought it was expensive, but then we put on a big position in the public markets, you know, like summer of 2020, because we thought it was very cheap. And so we're definitely willing to, like, you know, admit we're wrong and change our view on things. Sometimes you just miss the boat though, like with Matic, like, you know, I think it was like 2 cents and then it went up to like 40 cents. And then, you know, maybe you wait for a pullback to like, you know, 20 and it never happens. And then, you know, a number of months later, it's $2. You know, that's the way the business is. Sometimes you don't always catch every trade, but that would probably be my worst one.
I am curious. We talk about macro. We talked about, you know, kind of how you think about the space from the application layer, investing in base protocols. What is kind of like your highest conviction thesis right now in terms of perhaps over the next 1 to 2 years, and why?
Yeah, I mean, there's a couple things. I mean, one, like in terms of individual positions, like we really like Luna. I just think the team Do Kwon is like an animal in the sense of how hard he works and how fast he ships product and that sort of thing. And I like the ecosystem as well. Like we've backed kind of all the main projects he's you know built on top of it, and they've all been great from like an investment standpoint and also great from a traction standpoint. I think, outside of that, though, I'd say my highest conviction thesis is as a firm, we're very, very bullish on DeFi. I think it's just going to be the most transformative thing that comes out of this tech. Um, and it's something that, on the liquid side, like right now, it's actually, we're pretty underweight DeFi relative to historically, but I anticipate that'll change some point this year. I think DeFi, maybe it already has bottomed. There's certainly some technical indicator signs that it has bottomed versus ETH. But I kind of want to wait for a little bit more confirmation there. But I think have massive conviction in that, and just owning like a diversified portfolio of that. I think right now, depending on how you measure it, DeFi is maybe 5% of the space, something like that, in terms of overall market cap. And I honestly think, next 5 years, there's no reason it shouldn't be 40-50% of the space. And so that's sort of, it's a simple idea, but it's my highest conviction one.
Joey, there's this like narrative that DeFi will replace the banks, but then you start using these DeFi platforms, and I'm staying at an Airbnb with my co-founder right now, and he was playing around with Platypus last night, and it's like an AMM for stables or something like that. And I can assure you, this thing is not a retail platform. This thing is complicated as hell to use. So when you think about like the capital that comes into DeFi and the users of DeFi, where on the spectrum do you land in terms of like, okay, this thing's replacing the banks. This is a retail platform. We're all going to use these DeFi things as like where we keep our savings and stuff like that. The other end is like, no. Like the Jane Streets and the Susquehannas just end up moving into the space, and they're just basically generating like market neutral 12% a year through DeFi platforms.
Well, I mean, I do think retail will eventually use it. It may look a bit different though in a couple ways. One may be you have kind of companies built on top that make it really easy to use and access. Like that's a lot of what we've done with like eco.com, is like making it really easy to access crypto for people who have no idea what crypto is. And so I think that's going to be like part of it, is people kind of funneling into apps like that. And then there will be people who, use the actual underlying protocols with a UI in their browser. And I think it's fine to have both. And in terms of like the kind of browser style UI, I think those get way easier to use over time. Right now, there are things people have kind of slapped together, like the Platypus thing. Like, I doubt they're trying to target, bank customers in the US. They're probably just trying to target random people in crypto. But I think that'll change over time. As far as banks, I think they still will exist, and they'll probably be the ones that survive will probably just be, user interfaces that allow you to access this crypto stuff, in the very long run.
It's been interesting. Look, full disclosure, I have a position in Risk Harbor. I think they're doing some interesting stuff. Insurance to me has felt like one of those categories that is not very kind of sexy, but if you look over time, even going back to like colonial times or whaling industry, you need insurance. In the absence of generally, in the absence of having insurance, a lot of these industries kind of didn't really take off until you saw robust insurance solutions. And I think DeFi is sort of in that state where, look, there's a reason why you have a high APY. There's a lot of risk in the space. There hasn't been enough Lindy. You have this chaotic innovation, which is great, but time and time again, we see hacks, right? And so when you talk to a bank, when you talk to a large financial institution, they're like, this is too much of a Wild West for me. I'll come back when there's just more robust solutions out there. I'm curious from your perspective, Joey, like how would you characterize, like how far are we from a state of the world where a user doesn't even think about DeFi, doesn't even think that he's using crypto. It's just crypto on the back end. You're using the rails. You have insurance kind of mimic like FDIC insurance contract. You don't lose your funds. What do APY like yields look like at that point? And do you think there's kind of this common criticism of DeFi, which is, look, it's interesting because yields are high, and then there's a subset of like degenerate investors that are okay taking this risk because the yield is quite high. But once you have real banks come into the space, the yield gets crushed. Everything's very reflexive. Everyone walks away, and you're just going back to like traditional finance. I think that's a pretty harsh criticism. There's a lot of innovation in DeFi. There's a lot of friction that gets removed. But I'm curious to get your perspective. Because I've seen you kind of tweet a lot about like, Risk Harbor and Terra. And so I'm curious kind of how you think about just more generally the space and insurance and that kind of equation.
Yeah. I mean, I agree. Insurance is really important, and I love Risk Harbor. We're an investor in them as well, and I think the way I think in terms of rates, right? So like they'll come down, but like if you look at rates for like lending securities, they're like through your broker, for instance, they're like 4 to 5% annualized. Obviously, if you're a $10 billion hedge fund and have a prime broker relationship with Goldman, the rate's probably much lower. But if you're lending through a site like Interactive Brokers or E-Trade or whatever, it's in the neighborhood of 4 to 5%, which is higher than a lot of sources, but it's lower than what you have in crypto today. I think they will kind of trend towards that direction over time, but I don't think it's a problem, right? Like I don't think the main selling point of DeFi is that you have higher rates. I know some people say that because it's a great selling point, but it's not like the main benefit. It's this global financial system that's inherently trustless and has lower fees and all these other benefits. So I think in terms of insurance, way more capital will come into the space once insurance is more widespread. Because I mean, even Pantera, there's a lot of stuff we don't do in DeFi if we can't get insurance on it. Because like if the upside's 2x and the downside is you lose $20 million, like you don't want to take that trade. If you lose $20 million because you put on a $100 million position and it went south, that's something you can explain. But if you lose $20 million because you put it in a liquidity pool and it literally got hacked and disappeared, that's something that's much harder to explain. And sounds really bad. And so like there's a lot of opportunities and things that people would do in DeFi and capital that would be deployed if there was more widespread insurance. So I do agree that it's really key.
And you think that this insurance is very like it's DeFi native insurance, things like Risk Harbor, or I don't know what's going on with Nexus Mutual in the last like couple of months. I haven't looked into them recently, but that's kind of what it looks like.
I think it's DeFi native, and then you will have people in the traditional finance world who repackage it and sell it, as their own product, and you'll probably have people who offer it, who are completely centralized too. But I think the most successful ones will probably be other decentralized protocols, in my opinion.
Joey, I have one last question for you then. If you could shadow any investor or any builder for 30 days, who would it be and why?
Investor wise, I'd probably say Peter Thiel, because I think he understands, especially this current cycle, he understands macro really, really well. And that's something I want to understand more. And I think he's been very smart on that side of things. Outside of him, I think like you also have like Benchmark, like Peter Fenton and those people at the Benchmark are just really great in early stage investors, and I think learning from them would be cool as well. Builder wise, probably, I think it'd be interesting to just shout out Elon Musk. He's just super interesting and has his hands in a million things. So I think that would be fascinating.
Yeah. Very cool. Well, Joey, thanks again for sharing your thoughts. Thanks for sharing insights into how Pantera operates and what you find exciting. And I'm sure we'll do this again soon, hopefully.
Awesome. Thanks, guys.
Joey, thanks so much for coming on.
Thanks, Joey.